Two AI stocks I will never ever sell. I want to own those stocks for the very long term. Amazing companies, under the radar stocks. Not a lot of people talk about them on YouTube. I see a lot of Nvidia videos, a lot of Tesla and other kind of things around AI and automation and all these kind of things. But I don't see a lot of people talking about those two stocks. Those are amazing companies. One of them I haven't done an analysis on YouTube. I'm going to talk about it. The second one is a stock that a lot of you guys know. I'm going to talk about it again. But both of those companies are mainly a bet on the use of electricity and mainly the use of energy within data centers and AI in general. And in 2024, whenever I bought those stocks, I wanted to get exposure to AI, but I did not want to bother trying to pick winner, who's going to have the best chip, who's going to have the best product. I wanted a bet that I would win no matter what. And data centers all over the world, they consume more energy than countries, more than Italy, more than Taiwan, Australia, Spain, Thailand, South Africa, data centers alone. So they consume a lot of energy. And if I could bet on energy, I'm going to win no matter what. And this was my main thought process behind those two investments. And I really hope you enjoy this video. And the first stock that I own, and it's a very long-term investment for me, is CAG, which is Constellation Energy. It's up 30% year to date over the last 5 years. It's up 600%. I know a lot of you guys are going to click out of the video because you believe you're late to the party or it's up so much. But I'm going to show you the numbers, and the stock could still double in 4 to 5 years. It's still only getting started. It's not as late as you believe you are. I'm going to share everything. And I really hope you find some value. And Constellation Energy is the largest producer of carbon-free electricity in the United States, over 10% of the nation's carbon-free electricity. And what really drew me to Constellation Energy were the tax credits for nuclear. And once they established, I believe it was Clean Energy Act or Inflation Reduction Act or whatever it was, they gave those companies nuclear tax credits from now to 2032. And the nuclear tax credits, or you could say credits, it gave them a floor, like a bottom, on whatever they can get for the electricity that they sell. And this bottom means for Constellation Energy that they're going to get at least 13% growth from 2024 to 2030 in earnings per share. So no matter what it is, no matter how volatile prices are, because of those credits, they put a floor on whatever they can charge using 2% inflation. They go up with 2% inflation. So minimums, no matter what, Constellation Energy is going to grow earnings per share 13% from 2024 to 2030. And I just found this beautiful. The predictability was just beautiful. And this is why I wanted to invest in the company. And it's going to be valid not just to 2030, but mainly to 2032, 13% CAGR. And it's going to be amazing. But the company doesn't only grow 13% in earnings per share. They also have something called enhanced earnings. They take advantage of volatility, some shortages here and there, and from the demand, they can charge higher prices than the bottom of the credits that they get from the nuclear kind of credits. And they get even more enhanced earnings over the base earnings. And they were able to grow earnings per share 20 to 25% for a year. And this is just unheard of for a utility company or an energy provider, you could say. And there's many different things that's happening with the company. One of them, very recently, they got a contract with Microsoft to provide them for their AI data centers. And they're trying to restart their 3 Mile Island nuclear plant, which has been idled for many years, and they're trying to restart it and do many different things. And we'll see what happens with this plant. They got another contract from the US government to provide 13 agencies with nuclear, or you could say energy or electricity, whatever you want to call it. And it's a 10-year contract, $840 million. And they're getting a lot of things done. The company is looking amazing. And very recently, just a few days ago, they announced an acquisition of Capline. And Capline is mainly focused more on natural gas kind of provider for electricity and energy in general. And for natural gas, Capline, if you combine those two companies together, the output is going to be higher than NextEra Energy, higher than Vistra, Southern, Berkshire Hathaway Energy. They're going to be the largest kind of provider in the United States. So it's a game-changing acquisition for the company. And it's not cheap at all. They're issuing around 11.2 billion in equity, but now the stock is up so much and it's trading at a 100 billion market cap. So it's not going to be as bad as it is and they do have some debt with it, and many different things. But for me personally, I love the acquisition, and this is the main thesis for the video on why the stock isn't as expensive as you believe. And for the company, for their guidance for fiscal year 2026, this is what they have. They have the regular 13% growth from 2024 to 2030. They're going to have that every single year because of the credits, no matter what. And then on top of it, they have the enhanced earnings in the green, which is 20 to 25% on top of the base earnings. And then from the Capline acquisition, they have at least $2 per share each year. So each year they're gonna get an extra $2 per share on top of their own earnings per share for many years to come, at least $2. And Constellation Energy is normally, very conservative with those estimates, and they always revise them much, much higher. So it's gonna be massive, massive growth in earnings per share for the company with this acquisition, and it's just gonna be amazing. And for my valuation model, this is how I did it, and this is how I determined that Constellation Energy isn't as expensive as you believe. And I used their guidance for 2026 between 870 to 970. I used 920. I believe 920 is fair for the company. And by the way, 2026 is going to be a little bit lower than this year, fiscal year 2025, because they expect, some kind of outages, refueling outages, which does happen with nuclear companies every few years. You have slower years and you have better years, but that's why it's going to be a little bit slower in 2026. It will likely end up being much, much better, in my opinion. But I use the mid-range, which is $9.20. I use 17% earnings per share growth, which is their base earnings growth of 13%. And I added 4% of enhanced earnings on top of it. Normally it's much, much higher, but I added 4% of enhanced earnings. I got 17% in terms of growth, earnings per share growth. And I added the $2 extra on top of their earnings per share every single year, but beyond 2026 for the next 4 years. In total, I got $27.52 per share in earnings per share, 5 years from now. And I'm going to do a very basic calculation. I'm going to take that $27.52, and for a multiple, now it's trading at 33 times earnings, almost 34 times. We're going to assume that this is a little bit expensive for the company, and it should be trading around 25 times earnings. So I'm going to be conservative with this one. Okay, and we're going to take this estimate, which is 27.52, and we take 27.52, and we time it by 25 times earnings. If the company is growing around 16-20% earnings per share, I think 25 times earnings is fair. So we use 25 times earnings. This is $688 per share. We divide it by the current share price, which I believe now is at $3.13. In total, I would get 119% on the upside from this price, even though Constellation Energy is up so much. And this is excluding the 3 Mile Island. If they were able to restart it, this is excluding any more acquisitions, any more plans, any buybacks, anything that happens with the company, any better than expected earnings, anything good that happens, this is not included in this valuation. And I still see it double in 5 years. Now the stock is up so much, it's up over 33% or 30% year to date. And I'm not saying go FOMO into the stock. And of course, it could go lower. And if you're buying it here, you're buying it based on the best case scenario, not the worst case scenario. But even from here, the stock would still double. It's not as expensive as people believe. But now you do have my own analysis on Constellation Energy. And maybe it could help you out in having a thesis, putting it on your watch list. And maybe we have another August 5th or something happen, and you get to buy the stock like I did. This is what I did. I do my research first, and whenever we have a massive overreaction in the market, I jump in, and because I have my thesis, I can act quickly, and I can go and buy those stocks. And this is what I said on August 3rd. I said investors forgot about AI, data centers, clean energy, because we're going into recession. I hope it continues. And it was sitting at 167. I'm up 95% since then, but I still believe it's only getting started, and it's going to 600 something per share, 680 by 2029. And I love the company, and I'm staying in the company for the long term. The second one, which is less expensive than Constellation Energy, and it still has a lot of upside. And it's not a straight AI play, but it's somewhat of an AI investment. Now people are talking about it as an AI investment. And this is Cheniere Energy, which I talked about a lot on YouTube. It's up 14.5% year to date. It's still very cheap. And Cheniere Energy is mainly on natural gas. and they have the largest liquefaction facility in the United States, the second largest in the world. Over 11% of global liquefaction capacity is from Cheniere Energy, and natural gas has been used a lot to cool off and do many different things for energy within data centers. And a lot of them are getting hooked on natural gas and they're finding efficiencies using natural gas. So a lot of the natural gas stocks now are being labeled as AI investments. And that's one of the reasons why Cheniere Energy is taking off like crazy. And this is another AI investment, you could say, but it's also an infrastructure investment. It's a national security investment. It's an investment, or it's a bet on US natural gas exports to NATO allies, to Europe, to Asia, to South America under a new administration that wants to, balance their trade deficits through increasing production of natural gas. So that could benefit Cheniere Energy a lot. And they ship a lot of their gas. Most of it is in Europe. Then Asia is their second largest market. Then they have Latin America. And they have a few other nations. And this is Cheniere Energy. I talked about it many times, so I don't want to talk about it too much, but they have very long-term contracts, over 17 years of long-term contracts. And as you can see in their guidance, the long-term contracts almost equates the output that they put up in 2024. So they have a lot of visibility in free cash flow. And it's more of an infrastructure story than just a bet on natural gas, because most of their fees are fixed fees to liquefy the gas and ship it. It's not much about, wherever natural gas goes. Of course, if natural gas goes up, they're going to make a little bit more than if it's staying at $2 Henry Hub. But this is how I would look at it, and this is what I talked about before. And 2025 is so far looking much, much better. But for the valuation of the company right now, it's really not expensive at all. If you take that 3.7 billion of distributable cash flow, the company right now is trading at a almost 57 billion market cap. This is around a 6.5% free cash flow yield. For the kind of growth this company is experiencing, 6.5% free cash flow yield is really not expensive at all for Cheniere Energy. But my main bet on the company is them reaching their 2020 vision. And their 2020 vision is to deploy $20 billion of capital to buy back stock, 15% of the market cap by 2027, and do dividends, raise the dividends, and pay down the debt, do many different things. Deploy $20 billion, but also reach $20 of DCF, distributable cash flow per share, by 2027. And they intend to do that by buying back stock and completing their expansion of their facilities, the 9 trains plus CCL stage 3, and then they have a few more things they're trying to do, and they can complete it by 2027. If they do get it completed, they expect $20 to $22 in DCF, distributable cash flow per share. And so far, they're 6 months ahead of schedule. So it's looking very good. And this is how I would look at the company. It's currently trading at 24.5 times free cash flow. I'm going to use 20 time cash flow. I believe this is more conservative. So I take the 20 DCF per share and I time it by 20 cash flow multiple. I get $400 per share. The company right now is currently trading at $253 per share. In total, I would get 58% on the upside over the next 2.5, 3 years. So by the end of 2027, I see 58% on the upside. So this is another one that's also up a lot year to date. It's doing amazing for my own portfolio, but it's still cheap. It's still only getting started. It could pull back. Maybe the momentum could slow down, but it's still not cheap. If you like to dollar cost average down, both of those companies are not too bad. And those are my 2 AI stocks, Cheniere Energy and Constellation Energy. It wasn't financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.